It's 1694 in London, England. The government just borrowed $12 million, a colossal sum at the time. This wasn't cash from a king. It was a loan from 1268 private citizens and merchants. The deal created the Bank of England, and it completely changed who held the true power for centuries. Wealth was about land or gold, but now it was about access to credit. This singular move presented the core tension that still defines global economics today. Is money a stable store of value or a flexible tool of debt? To understand what's happening in your bank account right now, we have to go back to this exact moment. The Bank of England was the first central bank to issue permanent interest-bearing national debt. Before 1694, a king's default meant financial ruin for the lender. This new system promised repayment backed by the state's tax revenue. Suddenly, a loan to the government was the safest investment available. This allowed the British state to finance its wars without immediately increasing taxes. They exploded their navy and expanded global trade simultaneously. This is the first lesson. Whoever controls the national debt mechanism controls the nation's destiny. But here's where it gets interesting. The creation of this bank wasn't just about debt. It was about creating money that wasn't tied directly to gold. They established fractional reserve banking, which sounds complicated but isn't. The bank held only a fraction of the gold needed to cover all its issued banknotes. If $1,000 in gold came in, they could print and loan out roughly $9,000 in paper notes. This 10-to-1 ratio meant banks became instant profit engines. This mechanism is still the engine of global credit expansion today, and then everything changed with the 1707 Act of Union. Scotland and England officially merged, creating Great Britain. This created an even larger economic base to support the national debt. The debt itself didn't disappear. It just became a powerful unifying financial tool. The government was incentivized to protect the system's stability above all else. This is the pattern break. Stability became a commodity more valuable than gold itself. It signaled to the world that Great Britain's promises were solid, unlike its rivals. Which brings us to the next law. The establishment of secure property rights. Portugal did X. They focused on trading gold and spices, centralized control. Spain did Y. They plundered gold from the New World, leading to inflation at home. The Dutch did Z. They pioneered stock markets and joint stock companies, spreading risk. England, however, built a legal framework that protected private capital from the crown. In 1689, the Bill of Rights codified that the king couldn't arbitrarily seize property. The rich felt safe investing their capital long-term, accelerating innovation. This is why England's wealth accumulation rapidly outpaced its European neighbors. So what happens next when you combine credit security and a central bank? The rise of the factory system and the Industrial Revolution. The invention of the spinning jenny in 1764 required significant upfront capital investment. The newly liquid banking system was eager to provide it. The annual output of textiles exploded from £50 million in 1750 to £2 billion by 1850. This growth required continuous credit, which the 300-year-old system happily supplied. The law wasn't about gold. The law was about efficiently deploying debt into productivity. The people who understood this pattern became the new titans of industry. But here's where it gets interesting. This system had a predictable dark side, the boom and bust cycle, or what economists call the business cycle. Easy credit leads to overinvestment, or a speculative bubble. The crash always cleanses the system by destroying weak debt-laden businesses. The Panic of 1825 was the first major banking crisis of this modern system. Over 60 banks collapsed in the UK because they didn't have enough reserves. The system survives the crashes, but the financial elite always buy up the assets at a discount. This is the secret. The original money law favors those with capital during the bust. Let's jump forward to 1944, the Bretton Woods Conference. 730 delegates from 44 nations met to rebuild the global economy after the war. They adopted a system where the US dollar was pegged to gold at $35 per troy ounce. Other global currencies were then pegged to the dollar, establishing its dominance. This formalized the American financial model, and heir to the Bank of England's blueprint. Debt became global, backed by the largest military and economy in history. The U.S. national debt grew from $260 billion in 1944 to over $1 trillion by 1982, which brings us back to the original tension: stability versus flexible debt. And then everything changed again in 1971. President Nixon unilaterally suspended the dollar's convertibility to gold. The global system became entirely fiat, meaning money was backed only by trust. This was a radical break from the 300-year history of linking money to a physical asset. It was the ultimate expression of the 1694 debt-based money law. The amount of money the government could create was now functionally limitless. The U.S. national debt exploded from $400 billion in 1971 to $28 trillion today. The cost of this flexibility is paid by every saver who sees their dollar buy less and less. Which brings us back to today and the third law of accumulation. In a system powered by credit, assets funded by cheap debt inevitably outperform cash. Cash in the bank dropped from earning 10% interest in 1980 to less than 1% today. Real estate, stocks, and intellectual property are the only places for capital to hide. Consider home prices, which grew 300% faster than average wages since 1990. The new money law is simple. Debt-financed assets get rich. Cash gets poor. You are now forced to become an investor just to maintain your current standard of living. The system requires constant asset price inflation to function. This is the cyclical callback to 1694's credit creation engine. Portugal focused on gold, Spain focused on plunder, the Dutch focused on markets. America today is doing X again, maximizing flexible debt to drive productivity and assets. But the inevitable outcome remains the same for the average person. Your financial health is dictated by your access to and application of cheap credit. The individuals who master this 300-year-old law become the new elite.